Hello, everyone, and welcome back to the Saigal Seatrade podcast, where we deep dive into the maritime world one wave at a time. I'm Research Analyst Shruti, your host today, and we are setting sail through the volatile waters of crude, clean products, and gas shipping markets. From rate collapses to fleet expansions and regulatory overhauls, there's a lot going on. And to walk us through all of it, we have Mr. Sandesh Ghandat with us. Welcome, Sandesh.
Well, thanks, Shruti. It's as always a pleasure to be here, and the market looking more dynamic and fragile than it's been in years, from the Middle East flows to the tonnage crunch in the Americas. So we have got a lot to unpack this week.
Sure, so let's start with the big beasts, the VLCCs. So the latest numbers paint a gloomy picture. The TC is down by nearly 25%, and especially on the TD2 and TD3C. So what's really driving this bearish slide despite high production from Saudi Arabia and active West African stems?
Well, absolutely, Shruti. What we are witnessing in the VLCC segment is a kind of a textbook case of supply and demand dislocation. So let's take the Middle East Gulf, that is ex-MEG, as our example, right? Despite Saudi Arabia pushing out stems midweek, and the market reaction was lukewarm at best. And you may ask why? Because the tonnage list is long, oversupplied by 15 to 20% compared to the seasonal norms. So owners, they are holding older units and found themselves sidelined because charterers, they clearly preferred modern fuel efficient VLCCs. And even in the West Africa, we have seen a slightly firmer start because the momentum fizzled as fresh inquiries dried up, and by the week's end, TD15 it dropped by over 5 points, while TD22 saw a 0.63 million drop and marking a 12.83% hit to the earnings. So ex-USG, it remained soft too, and there is a interest from the US refiners, but insufficient to counterbalance the surplus. It was a floating tonnage. So it's not just about the cargo volume, it's about the forward visibility. Charterers, they are cautious, avoiding long haul unless pricing aligns perfectly. We have seen some VLCC owners, they are pivoting to shorter voyages just to stay moving and minimalizing their idle time. So this tactic repositioning shows just how squeezed the margins are.
Well, Sandesh, the Suezmaxes and Aframaxes are reacting quite differently. While some routes like the TD6 rose slightly, others like TD20 fell off a cliff. What are the underlying dynamics here, and how are owners shifting strategies?
Well, you know what? The Suezmax market is really a tipping point, and in the Middle East, we began with the balanced fundamentals, but then VLCC spillover began to hit the sentiments, and then the owners, they started redeploying into Aframax trades, which ironically further depressed that segment too. Now in the West Africa, Suezmax segment saw some hidden strength early on last week, and off-market deals, constrained tonnage, these are some of the things that has contributed to it. But as more ships ballasted in, the momentum quickly unraveled, and we have seen the benchmark TD20, it dropped by 12 points, and then we have seen the TC also dropped by 21.3%. Now for the Aframaxes, the picture was even grimmer in the Southeast Asia, because despite some demand like Kuwait's fuel oil steams or MRPL and BPCL spot needs, it has a kind of a competition from the larger vessels, and that's why it crushed the hopes of a rebound. So TD8 and TD14, both the benchmarks saw rates slide, with the Aframax owners looking at TCE erosion of nearly 5% week on week. And it's this tactical flexibility, and that's key for the owners. They are kind of a moving unit from and even across the basins, scaling down to the smaller routes and anything to keep utilization up, because their sole priority is keep the employment for the vessels. Maybe it's Aframax, Suezmax, or even the VLCC. But the more they do that, the more rates across the segments get diluted.
Now let's talk clean products. CPP markets are showing both strength and strain. The LR1s and LR2s rose a bit, but MR segments are under intense pressure. And there's this huge structural rotation looming from Russia-linked trade shifts. So can you please unpack this complexity for us?
Well, definitely, Shruti, the LR1 segment, we saw a 4.06% rise on the TC5 benchmark route, and then LR2 also gained slightly by 3.94 world skill points. And it's signaling some optimism, but, scratch beneath the surface, and we see that, these gains are sentiments driven rather than the transactional. So there is a limited evidence that they will hold even in the coming weeks. Now, in the West, sanctions on Russian crude are shifting capacity out of dark fleet trades and back into the mainstream, because we have seen that the price cap is getting lowered from $60 to $46.5 per barrel. But for the products, it remains same like they have been 2.5 years ago. So this is particularly true for the LR2s and MRs, because what we are heading towards is a scenario where these vessels flood open markets at a time when demand is already tapering. And then the MR segment tells that story best, because on a TC12 benchmark Sikka Japan route, we saw a jump of nearly world scale 9 points week on week with TCs. They are also up by around 9%, but that's isolated. And then in Southeast Asia, prompt tonnage is kind of a stacking up, and North Asia, it is holding for now, yet multiple discharging vessels are about to re-enter the pool and setting us up for a correction. Now combine this with the FFA structure showing contango, where future rates are expected to be higher, and we see that sentiment is more hopeful than the real. So the struggle is fragile, and traders and even ship owners, they know it.
Well, moving on, the LPG shipping is riding high for now. The AG Chiba hit $85 per metric ton. But with record vessel deliveries looming in 2026-27, are we staring down the barrel of an overcapacity crisis?
Well, first of all, Shruti, this is $1 million question. And you know what? On the surface, east of Suez markets kind of look strong, at least for now, because we have seen over 10 fixtures last week, and all for the August loading. So rates, they are holding in the low mid 80s, and west of Suez is quieter, but optimism lingers with the USG cargoes potentially popping up in for the early September times. But here is the long-term view. So in my opinion, 2026 new builds are set to surpass 2023's record by 15%, and that's huge. And then 2027 could jump another 46%. So we are already at 946 LPG ships globally, and you know what VLGC share amongst that? It's a 73% of the cubic capacity. And then we have seen Asia always dominates ownerships, because Japan holds 20%, followed by China, Greece, and Singapore. So the surge in the US LPG output, up over 10% annually for 3 years, has driven this particular investment boom. So yet speculative ordering, not demand, is driving most of this growth. So if geopolitical shift, especially US-China relations and then the trade routes, it could shorten dramatically and undermining the ton-mile demand. So yes, today's firm rates might feel like a super cycle, but without demand to match, it could morph into an oversupply of storm.
Well, Sandesh, let's zoom into India for a moment. With PSUs like IOC, BPCL, MRPL shaping demand for both crude and CPP, that is clean products, how is India impacting freight dynamics, and what can we expect in the second half of 2025?
Well, surely India's influence is kind of undeniable on a global spot. Last week, we have seen the Indian PSUs quoted only one VLCC cargo, and it was fixed at world scale 44. But in Suezmax and Aframax segment, the action was more frequent, because we have seen 3 Suezmax cargoes and 2 Aframax cargoes, with the later going on at world scale 119. With the refinery upgrades at Paradeep and Vizag, and rising domestic product export, India will continue to play a key role in the global arbitrage. The second half of 2025 could see higher long haul product moves towards the favorable markets like Southeast Asia, East Africa, and even in Europe. Now, it all will depend on how the pricing windows work out for these particular regions. And then, if diesel cracks remain favorable, India might even become a central export node for the ultra low sulfur diesel, that is ULSD, and putting pressure on the western CPP routes.
Well, Sandesh, this has truly been a masterclass in understanding the tides of tanker and gas shipping markets. Thank you for joining us today.
Thanks, Shruti. Thanks for inviting me once again. It's been pleasure to be here and sharing my thoughts with you and our audience. Thank you.
And to all our audience, thank you for joining in today and do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay tuned.